All right, let's talk about Palantir. This stock has been on an absolute tear, up over 130% this year, mostly thanks to all the AI hype. But lately, it's gone kind of quiet. It's pulled back. So the big question on everyone's mind is, what's next? Is this just the calm before another storm with the big players quietly buying in? Or is this AI rocket finally starting to lose fuel? Well, that's what we're here to figure out. We're going to decode the chart, look at the business itself, and see what Wall Street is fighting about.
Now, I've got a question for you. What if a stock chart could actually predict the future? I know, it sounds a little out there, right? But what if those simple patterns, the ups and downs in price, the amount of trading, what if they held clues about the next big move? That's exactly what we're going to do. We're putting Palantir's chart right under the microscope to see what it's trying to tell us. Okay, so first stop, the chart itself. You can see Palantir has pulled back from its highs. But here's the thing, it's how it pulled back that's so interesting. You know, to someone who studies these things, this doesn't look like just a random drop. It looks like what traders call a textbook setup, and it's sending out some really specific signals. So to read these signals, we're going to use a framework that's been around for about a century. It's called Wyckoff analysis. And look, the best way to think about it is like you're a detective. You're tracking footprints in the snow. In our case, the footprints are the stock's price and its volume. And by analyzing those footprints, we can try to follow the trail of the smart money, the big institutions, and get a sense of whether they're buying or selling, way before it ever makes the news. And here it is. This is our main piece of evidence, Palantir's daily chart. I mean, look at that. You can see that huge run up on the left, and then this gentle drift downwards. It's landed in a really, really interesting spot. So is this a danger zone, or is it a launch pad? Let's start breaking down the clues. Okay, clue number one is the price itself. Check this out. The stock didn't just stop falling randomly. It pulled back perfectly to a spot where a couple of key support levels come together. You can think of it like a safety net or a technical floor for the stock price. In Wyckoff terms, this is what's called a last point of support. And that's a big deal. It's often the final little test before the big uptrend kicks back in. All right, now I really want you to look at the volume bars at the bottom of the chart, because honestly, this might be the single most important clue we have. As the price was drifting down, what happened to the volume? It just dried up. It's way below average. What does that tell us? It tells us there was no real power, no conviction behind the selling. The big money, the institutions, they weren't dumping their shares. They were holding on. I love how the source material puts it. The sellers simply didn't show up. That says it all, doesn't it? And for our final technical clue, let's talk about momentum. So some of the key indicators we use to measure buying and selling pressure are doing something really interesting. They're coiling. That's the technical term, but just picture a spring being compressed tighter and tighter, building up all this potential energy. That's what's happening here. And this coiling action, it often happens right before an explosive move. To top it all off, one of these key indicators just flipped from neutral to green. That could be the little spark that tells us buyers are starting to quietly creep back in. So the chart is telling a pretty bullish story, right? It looks like the smart money is holding on, maybe waiting for the next move up. But you have to ask why. Why would they be so confident? Because let's be real, a pretty chart pattern doesn't mean anything if the company behind it isn't strong. So let's pop the hood and look at the fundamental engine that could be driving this whole thing. First things first, let's just take a moment to appreciate this number. The stock is up over 134%. This year alone. That's just wild. And this isn't some small rally. This is a massive repricing of the entire company. And what's driving it? You guessed it, the market's absolutely explosive obsession with anything and everything related to AI. And look, this isn't just market hype. It's being backed up by some serious accelerating growth. In the second quarter, Palantir hit a huge milestone. We're talking about their first ever billion-dollar revenue quarter. $1 billion. Now, for a company that's been grinding for years to get to this scale, that is a massive signal. It tells you their business model might be hitting a major turning point. So where is all that growth actually coming from? Well, this next number tells the story. For years, Palantir was known for its secretive government work, right? But check this out. Their U.S. commercial revenue, we're talking sales to regular businesses, it's surged by an incredible 93% year over year. That is the growth engine that has Wall Street sitting up and paying very, very close attention. And the secret sauce behind this commercial explosion? It's their new artificial intelligence platform, or AIP for short. I mean, companies are jumping on board at a crazy pace. Take Lear, the auto parts maker.
They expanded their partnership with Palantir after the AIP platform saved them $30 million. And we're not talking about small, niche companies here. Palantir is rolling out a client list that is basically a who's who of global business. You've got giants like BP, Novartis, American Airlines, all using their tech. Okay, so let's recap. The chart looks bullish. The company's business looks super strong. So this should be a slam dunk, right? Case closed? Well, not so fast. Because when you look at Wall Street, there is a huge debate raging about what happens next. And this is where things get really interesting. In one corner, you've got the bulls. You've got Bank of America saying, hey, this thing is going to 215. But in the other corner, you have the bears, like Mizuho. And they're saying, whoa, hold on, our target is only 165. And their whole argument is pretty simple. They're basically saying, yeah, the news is great, but isn't all that AI hype already priced in? And if you look at what the big investors are actually doing, it just adds to the confusion. The official consensus on Wall Street, it's just a lukewarm hold. You've got a huge AI fan like Cathie Wood trimming her shares, taking some profits off the table. But then, at the exact same time, you have other big funds just now starting to build a position. It's a classic tug of war between the people cashing out and the new believers just getting in. So, where does that leave us? We have a bullish-looking chart, strong fundamentals, but a totally divided Wall Street. How do you possibly turn all that into a clear strategy? Well, let's pull it all together and see what the analysis points to. So after weighing all the evidence, where do we actually land? Well, according to this analysis, the technicals, the clues in the chart, are speaking much louder than all the debate on Wall Street. When you combine the price holding that key support level, the super low selling volume, and that momentum coiling up like a spring, it all points to one clear conclusion: a strongly bullish bias. The chart seems to be saying the path of least resistance is higher. Okay, so if the bias is bullish, how do you actually trade it? The source lays out two potential ways to play this using options. First up is the bull call spread. Think of this as the more conservative play. It's good for a steady, moderate move up, and the best part is your risk is totally defined up front. Then you have the second option, buying a single call option. This one's more aggressive. It's a bet on a sharp, fast, explosive move higher. But the primary recommendation from the analysis is actually the more conservative one, the bull call spread. Now, why is that? Well, it goes all the way back to that last point of support pattern we saw on the chart. That pattern usually suggests a steady grind higher, not necessarily a huge, sudden explosion. And this strategy, it's tailor-made for exactly that kind of move. It lets you play for that upward grind while keeping your risk locked down from the get-go. Okay. Now, let's talk about what is probably the single most important part of any trade idea. I don't care how bullish a setup looks, you have to know your exit plan. Knowing when you're wrong is everything. Risk management is king. So here's the game plan, laid out nice and simple. Step 1 is the stop loss. This part is non-negotiable. A daily close below that blue trend line, right around $172, and the whole bullish idea is off the table. Simple as that. Now, if it works, step 2 is the first profit target, a retest of the recent high up near 190. And if the stock has some real juice behind it, the stretch goal, step 3, is up in the $200 to $205 range. So there you have it. You know where you're wrong, and you know where you're looking to take profits. So there you have it. The technical chart has written a very clear script for what could happen next. But there is one massive wild card in the mix. The company's Q3 earnings report is looming right around the corner. And that brings us to the ultimate question. Will the company's actual fundamentals, their real business performance, show up and validate the incredibly bullish story that the chart is already telling us? That is the billion-dollar question, and we're all going to be watching very closely to see how it plays out.